Okay, Chapter 4 deals with consolidation in the financial statements when the companies have inventory sales, intercompany sales back and forth. So whether the parent's selling to the sub or the sub selling to the parent, there's going to be some intercompany sales, and those intercompany sales need to be eliminated. The only time the profit can stay is if it's been sold to an outside party, if it's a true sale to an outside person. If it's just between the two companies, if you're thinking of that big consolidation, it's just still within the company. It just moved from one location to another, really. But because they are separate entities, they still are going through the regular sales process, invoicing their client, who again might be their subsidiary, and then that client is paying them. So all that stuff is still happening. So what you have to do is kind of map those out in addition to the other entries that we're still working on. You know, we still have our E entry to eliminate the equity. We still have our A entry to set up the acquisition accounting premium assets. We still have the C entry that deals with the equity income and the dividends paid. And then we still have our D entry, which deals with the depreciation of those acquisition accounting premiums. But then now we're going to have I entries, and we're going to have multiple I entries. So if we have a problem where the parent company acquires the subsidiary company January 1st, 2010, the purchase price is $500 million in excess of the subsidiary's book value, and they've mapped those out. So we have property, plant, and equipment at $100,000, a customer list at $175,000, a royalty agreement at $125,000, goodwill at $100,000. They also give us the useful life. Property, plant, and equipment is going to be amortized over 20 years, customer list over 10 years, royalty agreement over 10 years. Then they give us their inventory transactions. So then now they say the parent sells inventory to the subsidiary, and then the subsidiary ultimately sells it out to the outside customers. But in 2013, so 2013, that's the year that we are in, they have inventory sales of $68,000. They have gross profit that's left in their unsold inventory of $19,380, and then they have a receivable and a payable, because again, like I said, they're invoicing their customers. Customers are paying them within their terms, so there would be a receivable and a payable, and then plus now there's some left in inventory. Then they also give us the 2012. They say that there was $12,597 of profit that was left in last year's inventory that was then sold in 2013. So then they give us the financial statements of the two companies, and then they ask us to kind of map things out. So the first thing that we'll kind of do is, the first thing that they're actually asking us to do is to backtrack into what the equity income is. So when we are asked to do that with our equity income, we always start with the sub's net income, and that we're going to pull right from their income statement. So if we go to their income statement, it's $109,620. Then we're going to subtract the depreciation on the acquisition accounting premium, assets, and the amortization. So the depreciation, it told us that the property, plant, and equipment was $100,000 being amortized over 20 years. So that's going to be $5,000 a year. The customer list was $175,000 amortized over 10 years. So that's going to be $17,500. And then we have one more amortization. And that is the royalty agreement of $125,000 over 10 years. Now, in the past chapters, we might have been done. We might have said, okay, well, that's it. That's all the adjustments we have. It's not true now. If you can remember back to chapter 1, when we were doing the equity method accounting, we had a problem where there was the inventory, and we knew we had to adjust the sub's net income for the gross profit that was left in that ending inventory. So it's the same thing here. So now the 2013 gross profit deferral we have to subtract that out. So the 2013 gross profit that's remaining in unsold inventory is $19,380. But we get to add back the 2012 gross profit deferral because that was sold in 2013 and it was sold to outside parties, so now we can include it. So now we can see, though, to reconcile out this equity income, it's a little more complex when we not only have amortization and depreciation, but we also have the inventory adjustments. So I'm going to double check these and see where we're at. So that gives me $67,837, and then always double check that. So I double checked it. That is my equity income that the parent shows on their income statement, and that's what we're going to eliminate in consolidation. But at least now we know that we have kind of mapped all those things out. Okay, then the next thing it says is, okay, it says map out what's in the equity investment balance. So then now that also gets just a little bit more complex. A lot of it's the same, but so we've got our E entries. So we've got our common stock, our paid-in capital, and our beginning of the year retained earnings. So again, we go to the subs balance sheet. Our common stock is $52,200. Our paid-in capital is $65,250. And then our beginning of the year retained earnings, again, is the beginning of the year, so we go up to the statement of retained earnings, and that BOI retained earnings is $404,550. So then we're going to subtotal those, and again, that's going to tie out to our E entry. And that gives me $522,000. Okay, then we go to our A entry, but again, remember it's beginning of the year. So we are now in 2013. The acquisition happened in 2010, so we would have depreciated 2010, 2011, and 2012 to get to our beginning of the year 2013 balances, those 3 years. So we would have property, plant, and equipment, and that was at $100,000. We're depreciating it at $5,000 a year for 3 years. That's going to be $15,000.